All right, we got Options as a Strategic Investment by Lawrence McMillan. Now, if you don't know options, then it's going to be this as it's not going to do anything for you. But let's see what strategies he's discussing. Part 1, the basic principles of stock options. Part 2 is call option strategies. Part 3 is put option strategies. Part 4 is additional considerations. Part 5 is non-equity options. That's kind of interesting. Let's look at, well, first, I like this additional considerations. What got me was buying options in treasury bills. Man, this is actually a pretty intense book. If you look at it, I'm like, this is actually pretty cool. It got, because with most stock market books, they're very specific. When was this written? 1986. Because the reason I'm saying this, because he has arbitrage, mathematical applications, mathematical considerations for index products, index spreading, taxes, stock index hedging strategies, standard option strategies using index options, other non-equity items, introduction to option products. So, because then it has indices, cash-based options, futures, options and futures, under taxes, history 608, basic tax treatment, exercise and assignment, special tax problems, and tax planning strategies for equity options, right? I mean, so this is more intense that I've seen than most books. So it's pretty cool. Not to mention, obviously, it has all the option strategies, but these are just additional considerations and non-equity options, right? So let's start with buying options in treasury bills, 353. Okay, chapter 25. Numerous strategies have been described, ranging from the simple to the complex. Each one has advantages, but there are disadvantages as well. In fact, some of them may be too complex for the average investor to seriously consider implementing. The reader may feel that there should be an easier way. Isn't there a strategy that might not require such a large investment or so much time spent in monitoring the position, but would still have a chance of returning a reasonable profit? In fact, there's a strategy that has not yet been described, a strategy considered by some experts in the field of mathematical analysis to be the best of them all. Simply stated, the strategy consists of putting 90% of one's money in risk-free investments, such as short-term treasury bills, and buying options with the remaining 10% of one's funds. Okay, I get you. I mean, in 86, T-bills were probably paying more than they are right now. All right, but let's keep going. It has been previously pointed out that some of the attractive strategies are those that involve small levels of risk with the potential for large profits. Usually, these types of strategies inherently have a rather large frequency of small losses and a small probability of realizing large gains. Their advantage lies in the fact that one or two large profits can conceivably more than make up for numerous small losses. This treasury bill option strategy is another strategy of this type. Okay. How the treasury bill option strategy operates. Although there are certain details involved in operating this strategy, it's basically a simple one to approach. First, the most that one can lose is 10%, less the interest earned on the income or the fixed income portion of his portfolio, the remaining 90% of his assets. During the life of the purchase options, it is a simple matter to space out one's commitments to option purchases so that his overall risk in a 1-year period can be kept down to nearly 10%. Now, let's go for an example so he breaks it down just a little bit more. Example. An investor might decide to put 4% of his money into 3-month option expirations or 3-month option purchases. Thus, in any 1 year, he would be risking 16%. At the same time, he would be earning perhaps 6% from the overall interest generated on the fixed income securities, which make up the remaining 90%. Of his assets, this would be kept his overall risk down to approximately 10% per year. They were paying 6% a year in T-bills. Wow. Yeah, this strategy would work with that. It doesn't work with like 0.1% in T-bills. However, yeah, let's move on to something different. I mean, I'm not gonna say that it's a bad strategy. It's probably perfect in a world where interest rates are higher, right? But in a world where interest rates are really, really low, you'll probably lose money from inflation by doing that strategy. All right, they got one strategy called the best strategy. It's chapter 26, page 363. There is no one best strategy. Oh, well, I'm apologizing. They call this the thing the best strategy, and then they say there's no one best strategy. Although this statement may appear to be unfair and disappointing to some, it is nevertheless the truth. Its validity lies in the fact there are so many types of investors and no one strategy can be best for all of them. Knowledge and suitability are the keys to determining which strategy may be the best for an individual. The previous 25 chapters have been devoted to impairing much of the knowledge required to understand an individual strategy. This chapter will attempt to point out how the investor might incorporate his own risk-reward attitude and financial condition to select the most feasible strategies for his own use. The final section of this chapter describes which strategies have the better probabilities of success. Okay, I like it. Too bad we're running out of time. Let's see. Mathematical rankings. We're already done, so let's just go. We're going to do the summary. Let's see what they say. Mathematical expectations for a strategy do not make it suitable even if the expected returns are good, for the improbable may occur. Profit potentials also do not determine suitability. Risk levels do. In the final analysis, one must determine suitability of a strategy by determining if he will be able to withstand the inherent risk, if the worst scenario should occur. For this reason, no one strategy can be designed as the best one, because there are numerous attitudes as the degree of risk that is acceptable. It's a good one. Option strategies as an investment. I really do like this one. So if you would like this, and if you, I mean, it's a little dated. Well, it's a lot dated, right? You know, they didn't have internet and everything back then, and interest rates were high, so it's very dated. But if you want to know the historical strategies of options, what worked in the past, then this is a great book for you. So if you're a history buff, then this is great. Especially if you're a history buff when it comes to financial markets, then this is truly great for you, right? Which I am. However, it's not going to make the list, and I apologize for that. It just doesn't make the list at this very moment in time. Maybe later it will. So if you would like to read this, and then you can, and please, if you read it, then please write your comments, and I would love to have a conversation with you, and let's go over it, right? You can basically read it for me. So if you'd like to do that, then click the button. It'll be sent off to Amazon, and you can purchase this. And then I wish I could say, put your email and then put on the list and we'll read it together, but we're not going to, and I apologize for that. But I will see you soon.